Okay, let's go. Get going. So, Richard, if you wouldn't mind, just starting off, just explain who you are and where you came from and just work down the line. That would be super.
Sure. Thank you very much. Good afternoon, everyone. Thanks a lot for having me. My name is Richard Lum. I'm one of the founding partners of Victory Hill Capital Partners LLP. We're a sustainability-focused investment manager, specifically in the energy space. I'm Chief Investment Officer of our global infrastructure strategy. Excuse me. I spent the greater part of the last 3 decades investing in and financing energy projects globally. That's my background.
Hello, everybody. My name is Richard Hull. I'm one of the founding partners of Hydrogen One Capital. We're listed back in 2021. We invest exclusively into the hydrogen sector. That's companies that make the kit that goes into the hydrogen sector and the companies that actually produce the green hydrogen. Prior to that, I worked at Artemis as a fund manager, running the energy portfolio. I have an admission, I actually come from the oil and gas background. But the oil and gas sector is it's seeing the end of days for the small and mid-cap companies. But the small and mid-cap in hydrogen is absolutely fascinating, and that's what we're doing. And looking forward to the discussion.
Good afternoon, everybody. I'm Ross Greer, Chief Operating Officer and Head of UK Investments for Next Energy Capital. I look after both a public and a private fund in the UK environment. The public fund is called Next Energy Solar Fund, which was listed around a decade ago. So I'm really keen to talk to you today about some positivity.
Excellent. Right. Thank you, gentlemen. Apologies, because I think this first question, we used to kick things off, came up as a sort of discussion point in an earlier panel, but I think it's probably worth exploring in more detail. So, with a sort of recession, a growing possibility in a number of markets, do you think sustainability considerations could take a significant backseat during a downturn, or is the trend towards greater sustainability irreversible? Would you like to take that, Richard?
Yeah, no, sure. I'll give you a little perspective from certainly the energy space and sustainable energy. And I think really what we're seeing is the short answer is irreversible trend towards a transition towards a sustainable energy future, and achieving net zero. I think, what we're fundamentally facing off to here is a second industrial revolution in scale and depth and significance. I think probably you didn't see that over the last 18 months or a couple of years with Ukraine and the Russian invasion of Ukraine. The focus was very much at that point in time on affordability and affordable energy and ensuring we had sufficient supplies of, in this case, natural gas, etc. And so people thought, oh, well, hang on a minute, that's going to be a retrenchment of the sustainability agenda here. But really what I think happened was a lot of policymakers especially realigned the supply side focus into being less dependent on natural gas or fossil fuels and much more into renewables technologies especially, and factored in the idea that Russian gas is no longer going to be part of the mix. So I think it's actually accelerated really the drive towards implementing sustainable energy globally. And we still believe actually as Victory Hill that it is a very vibrant and rich opportunity set. I mean, I think we're looking at requiring about $2 trillion worth of investment per year to be able to achieve those types of targets that the International Energy Agency has forecasted. We think that's probably a really conservative estimate, really, because that just focuses on green electrons and production of green electrons. I think we also have to focus on the way you get the electrons to the user, i.e., grid infrastructure, etc., that requires a significant amount of investment as well. So, rich opportunity set from our perspective still.
Super. Would you say that applies to the pipe space as well?
Yeah, I definitely would, and I'd follow on from Richard's points to say that in the old days, if you look at our measure of sustainability in terms of environmental social governance, ESG, it was previously a box-ticking exercise, and therefore you might offer the thesis that let's just stop ticking the boxes when things are looking a bit grim because that's a bit of hassle, and then go back to ticking boxes later on. It's really changed. It's not like that anymore. At Hydrogen One Capital, we're an Article 9 fund, which means that everything we do, everything we invest into, is not just about what we say and do. It's about what we make our private companies do, we have to make sure they've got board diversity. They know where they're buying their products from, where the materials are coming from. It's embedded in the fabric of what we're doing. So you can't stop it.
Yeah. Would you have anything to add to that, Ross?
No, I think the Richards have done a great job there. I guess the point about ESG being woven into the fabric of everything we do is key, right? We call it part of our DNA. We believe that if you're charging a premium for delivering those kind of ESG sustainable returns, then there may be a challenge in that business model. But where it's a core part of the mission that your organization has and how you run each of your funds, we're also Article 9 across all of our funds as well, then it's part of the day job, and we see capital continuing to want to drive into that space.
Yeah. Okay. Take the next question. So, with the UK government's recent shift away from its climate change commitments, are there signs of other governments doing this? And what does it mean for each of your strategies? Would you like to take that first, Ross?
Sure, yeah. So I've got a personal and a company view. So the personal view is the government's run broadly the wrong direction for the last decade, and we've been super successful in establishing things like solar PV as a core part of the energy mix. So very short-termist, electioneering makes very little difference to that inevitable tidal wave of investment that we need to achieve a sustainable future. I believe the masses now are driving towards that sustainable future they want to see. People want to achieve net zero. They don't necessarily know how to go about it. They don't necessarily know what net zero feels like, but they know that they want to get there. We do see a kind of balancing of markets globally. So some super focused on driving towards a net zero future. We see other markets looking at how they can achieve it without really making positive and tangible steps. So it's definitely not consistent across the globe. I think from my organization's perspective, what we see in the fundamentals of the platforms that we operate are a core set of really robust generators that will be successful irrespective of what happens next in the market. So if there's a significant volume of new capacity to be realized, that's great news. That increases our investment set. If things like the grid challenges that we all know exist, that's great news for the existing generator set. So any which way, I think these trusts that focus in this space have a super successful decade ahead of them.
Okay. Would you want to add something for Poetry?
Yeah, I mean, it's a broader issue, really. I've got some sympathy with the UK government in managing a balance sheet in tough times, because we're all facing that in managing our capital, particularly in the renewable sector and the hydrogen sector. So things have been postponed, but you've got to be careful not to sort of pick up on a lot of short-term journalism that's made on the sector. We use the climate change performance index to look at countries, and how they compare to other countries. And that sort of takes into account policy, use of energy, the amount of renewable energy that the country's got, and emissions. And when you put all those together, the UK is actually in the top 10. So it's doing pretty well, but it's falling down the list because of one low score, and that's on policy. So policy compared to other countries is worsening. We're starting to lose our lead that we did have in the renewable sector, and particularly in hydrogen. And so that's a bit of a challenge. But the way around that for a renewable fund is just to have a global investment policy, which is what Hydrogen One's got. So yeah, it means that we'll start to move capital away from the UK and more towards the better countries and regions. And for hydrogen, that's definitely Central Europe, the Nordics, the US in terms of Inflation Reduction Act, which made a big difference in policy, and to Asia Pacific as well. So it's a problem if you're stuck in the UK, but the way around that is just to think international.
Richard, do you have anything to add?
Yeah, look, I mean, we absolutely agree with the point that Richard made in terms of the global perspective. I mean, our strategy is, as a global manager, we think the energy transition and being able to make an impact on that has to be approached within a global perspective, because it's not only a UK phenomena or a Western European phenomena, it's a global phenomena. So I guess from an investor perspective, in order to be able to connect with making an impact, you need to participate in a global fundamentally in a global format. And actually, it just so happens that's the best way for you to actually get differentiated returns from your investments as well, is to look at it from a global perspective, as opposed to just participating in a highly saturated, concentrated market, for example, renewables in Western Europe, that is backed by subsidy, etc. As we've known before, that results in compressed yields. And how much incremental impact are you actually making by giving that incremental dollar in somewhere where it's highly saturated, as opposed to elsewhere where they do need to actually make a real transition? So that's the approach that we take. It's pretty simplistic.
Okay. So next question is on discount rates. There is some confusion, certainly for some investors, as to why these don't move in lockstep, one-to-one, with interest rates. Would anybody like to sort of shed some light on that?
Let me have a go. As a fairly specialised investment trust in the hydrogen sector. The way that we're managing our valuations is from a starting point of discounted cash flow models. Believe it or not, hydrogen is quite a well-developed sector globally. These are not experimental companies where we're trying to value intellectual property. It's cash flows. And so we're valuing the businesses based on cash flows for the next 20, 25 years. So even though you might get a short-term risk-free rate change in Germany, for example, we've got German investments, it's not going to be at that level for the next 20 years. So what we're doing is taking the forward curve of the risk-free rate, and then that reflects into the cash flows that discount back to today. And that is a specific technical reason why a move today has a minimum, not as much impact as you might think, because we're not using the risk-free rate for the next 20 years. It's put onto a forward curve.
Would you gentlemen have anything to add?
Pretty similar, methodology really. When you're dealing with real assets, in particular infrastructure, there are various risk premia that you have to put onto your risk-free rate as well, that don't necessarily correspond on a one-to-one basis with rises in interest rates, etc. We're dealing with stuff such as potentially, market price volatility, for example, if you're exposed to power prices, etc. And the more you are, the higher the premium you put onto it is. That's the way we approach things. So they have very key specificities in every premium that we put on that may not necessarily correspond on a one-to-one basis.
Okay.
It also remains an attractive asset class. There's an undersupply of projects relative to the amount of capital seeking a home in a lot of markets as well. So that does provide natural tension with that one-to-one linkage.
Yeah. Okay. Something that you picked up on was availability of grid connections, which is very much as a problem here in the UK. Is that something that we're seeing globally?
We're starting to, definitely. So I'm going to talk from a solar PV perspective. The guys can talk about other technologies. It's an inevitable challenge in the march towards that net zero future that we've spoken about. If you look at the UK market specifically, we've underinvested in the grid for the last 10, 15, 20 years. It's very difficult to have predicted over the last decade how successful distributed energy was going to be and where that investment should be driven. I sit on the UK government solar task force. Part of the job for that is to achieve the roadmap for 70 gigawatts by 2035. And that's all about helping various different aspects of that delivery process to understand what that's going to look and feel like. Part of that is grid, part of that is planning resource and so on. So there's definitely challenges in the grids. We're kind of fortunate that as an organisation, we've been developing for quite a period of time in the UK. So we have a head of steam for projects that are short dated in that connection run. So that's valuable in terms of the continued growth of our platform. And final bit to add there is something I picked up on earlier as well, is a lot's being done to unlock these grid challenges across the globe. As a generator, if they fail to unlock, that is a positive thing. We will be more successful. We will generate more cash as an existing generator. So I think, again, the listed trusts are well placed to be successful regardless of the outcome, albeit personally, I do want to see a significant increase in distributed energy.
Okay. Is that a similar experience for you, Richard?
Yeah, no, look, I mean, we're a global investor. So, for example, in Australia, where we manage investments, Every energy market in particular, have particular limitations, and that's what we like about actually investing globally, because we believe limitations lead to dislocation, which leads to opportunity. Within the context of Australia, for example, as it relates to the grid network, I explained this a lot to our shareholders. On the eastern coast of Australia, that's where you get the large, the big trunk line, as it were, in terms of supplying electricity, because that's where the major conurbation areas are. But fundamentally, where you get the largest amounts of solar resources as you go further inland. So really getting those electrons to where they're needed most is a big issue, fundamentally, and being able to connect your project to it, if it's indeed a large scale project, is an issue. So you take an alternative approach. You start thinking about another way of conceiving grid connection, which is a sub 5 megawatts, for example, which supplies the locality or the region, as opposed to having to go to the major conurbation areas. There are interesting ways of doing this, and that's the approach we've taken. We have a sub 5 megawatt program there that we hybridize with battery storage. So it's really the approach as well, and limitation is opportunity, as was mentioned earlier.
Yeah, it's a key part of the hydrogen sector as well. In Hydrogen Capital, the fund, 7 of the companies are engineering businesses that make electrolyzers and fuel cells, but 2 of the companies actually make green hydrogen. To make green hydrogen, you need green electricity, so you need a grid connection. And what we're finding with project developers around the world, we're currently invested into projects that are coming on stream in Norway, and in Germany, and it's a first mover advantage to get that grid connection. So you've got access to the green electricity that you need to make the green hydrogen. So it's a very important part. And if we project forward, it's going to be a nice problem to have. We're not there yet. Is that you'll have hydrogen production competing with straight green electricity for access to that green electricity. One of the ways around that is Ørsted and Vattenfall, because the Nordics are sort of leading this area, who've got big wind farms offshore in Denmark and elsewhere, are putting electrolyzers onto their platforms, and then turn the electricity straight into hydrogen, and then transmitting the hydrogen to shore, either to be turned back into electricity because the losses from the hydrogen in the pipe are less than the electricity running for miles on the seabed, or into the growing hydrogen market on the continent.
Very interesting. I just want to talk about some biodiversity for a moment. So there's been a sort of trend of encouraging biodiversity, particularly say on solar sites, etc. So what sort of things are you doing?
I'll take first run at that, if you like. So we noticed very early on, about a decade ago, that there was a unique opportunity to do more than just generate green energy from a solar asset. And as part of its integration with the community in which it's embedded, we realized you could use that land to not only continue its agricultural journey, so grazing, for example, on the vast majority of our assets are grazed by sheep, but also to protect and enhance biodiversity. So we have an ecologist that focuses on ensuring we have specific measures delivered on each of our assets that protect and enhance biodiversity, provide ecosystem services to surrounding farmland, that has sufficient or has exponential benefits for the surrounding community on top of the generation of green power. So it's a unique opportunity. These assets, if you think about them, are fenced off from general traffic. They're removed from intensive agriculture. They're left alone for 30 to 50 years, apart from the traffic that we control from an operations perspective. So it's a unique plot of land in an otherwise unmanaged universe that is failing to protect biodiversity.
Yeah, I think from our perspective, any infrastructure project in conceptually, displaces biodiversity to whatever extent. So if you're going to undertake one, then you want to try to do it as least, problems, create as least problems as possible, and have the smallest footprint as possible. I think the real conversation that we have is mitigation, in particular, in terms of biodiversity on our projects. And I think grazing is one approach to solar farms. We have a 200 megawatt hydro facility in Brazil that we acquired last year, and really we're talking about soil erosion and mitigation of soil erosion around the water there, providing access for the fisheries actually to go through the dams is super important as well in terms of mitigation on biodiversity. And we're talking with consultants, particularly the International Hydro Association, the IHA, for certification to ensure that we adhere to standards and implement standards for mitigation of biodiversity in that area as well. And we were talking about other stuff as well. For example, we're talking about optimizing the project through putting floating solar on the reservoir itself, actually the river itself, and that will actually ensure that there is a promotion of aquaculture subsurface through having that type of cover on the top. These are really interesting things that we're looking at as well.
I mean, Ross and Richard have kind of covered it really. We have got some projects in Norway where the other big industry in Norway, of course, is fish farming. And so in bringing water into electrolyzers along with electricity, and you split the water and make the green hydrogen, we're also sharing that water with fish farms as well.
Oh, wow.
And it's part of the regular kind of site surveys that we do, as a sort of infrastructure and project management.
Probably just nice to sort of follow up that. What sort of industries is green hydrogen able to decarbonise?
Yeah, that's a good one. Well, it's the existing hydrogen industry, which is a $175 billion industry every year. So where is that hydrogen being used? It's being used as a reducing agent for making cement, for making steel, electric arc furnaces, which is a new way of making steel. One of the big uses, of course, is in fertilizer manufacture. Anything that goes into ammonia comes from hydrogen, and it's a big sector in the oil sector as part of desulfurization. So that's grey hydrogen. That comes from heating up steam and methane to about 1,000 degrees, which is very, very bad for the environment. So all of those industries are in a mad rush to convert that grey over to green. So that's where it's coming from initially, and that's what the entire thesis of our investment is about now. It's about switching the grey to green. We're not evangelical about everybody driving hydrogen cars. Mobility comes later as you move into the high end of the mobility sector. But yeah, that is the existing industry, and that is going on now, clearly.
Just want to talk about some supply chains for a second. So we've seen a number of funds talking about problems they've been having with their supply chains, whether it's sort of sourcing components ethically, or whether actually you're seeing big increases in the prices of those components. I mean, what have been your individual experiences? Ross, would you like to take that first?
Yeah, happy to. So from an ESG perspective, we have been very proactive in looking at the solar supply chain, particularly across the globe. There are inherent human rights abuse risks within the way some of those underlying components are created for solar PV. I mean, that's the same issue for all technology companies, but there is particular focus in the UK. We chair the Solar Energy UK's Sustainable Supply Chain Working Group, and that's all about driving industry to create force throughout that supply chain. We're driving for auditability and traceability in all aspects of the underlying supply chain, and we're able to achieve that quite successfully at the moment. So the latest modules that we have brought into our projects are certified as free from production in Xinjiang, which is the area where we bear the most risk of human rights abuse, and we'll continue to drive that further forward. ESG is a journey in supply chains, so it's definitely not resolved today. It will be something we focus on for the next decade, but the industry as a whole has upped its game massively over the last few years, and we're definitely running in the right direction, which is very pleasing to see. Solar PV has in recent years felt the pressure post-COVID. So obviously supply chains were very much restricted. We saw also exponential growth in demand post-COVID as people were driving the green agenda, especially things like the IRA in the States. However, we're starting to see now prices normalize again. So we are now seeing solar PV prices for the upcoming pipeline at very competitive price points, again, very similar to what we saw around in 2019, 2020 territory, which is really good news for future projects in the future that are going to set to be constructed across the globe, and also for continuing to maintain existing assets. One of the things we do is procure globally. So we procure across markets to ensure we have consistency of product price point as we see our projects coming through the pipeline.
Yeah, no, pretty similar, really. I mean, in terms of the diligencing of suppliers, I mean, it's really important to us. We take it very seriously to be able to look into the supply chain of, the renewable projects that we're involved in, whether it's solar, etc., and ensure that the suppliers themselves adhere to human rights standards as well as other, sustainability criteria that we use. We actually front end the sustainability element of our, the prospective deals that we look at fundamentally, and it has to fit through the 6 UN SDGs that we have, identified as the prism for our investments before we consider it from a commercial perspective. But we do additionally due diligence on the supply chain. I think one other point to note in terms of what's been going on, and I agree with Ross in terms of that, fundamental oil pricing increasing over the last 2 years or so, certainly after COVID, that's dropped off a little bit. But I think a lot of subcontractors who are involved in this space, particularly, are feeling the heat in terms of the higher interest rates environment and inflationary pressures. Their margins are getting really, really squeezed, and that's really changed their behaviour towards main contractors, etc. And they would rather shoot first and ask questions later. Something that you have to manage quite actively as an owner.
Yeah. Okay.
I can be very specific about this. Being on the side of the hydrogen producers, there's a global shortage of electrolyzers. It's already started. The electrolyzer, water, electricity makes green hydrogen. We're having it's not so much in terms of an inflation on price, but just availability, and that affects cash flows because we're having to put deposits down to get to better order electrolyzers for projects. So it's like advancing cash flows, increasing working capital to go into these businesses. And then more specifically, it's basically transistors, computer chips that go into very specifically programmable logic controllers, PLCs, the control systems that go into a lot of these projects. So there is a global shortage of those at the moment. But in terms of what difference does it make to overall capex, it's not that much. It's about 5 to 10% increase in capex. And when you run your sensitivities on hydrogen projects, the thing that affects the value the most is the price of the hydrogen and the price of the electricity that you use to split the water. CapEx is a relatively small part of it. So overall, it doesn't really have that much impact.
I think what you're seeing is the benefit of the experience of the managers in this space as well. So, for Next, for example, we are a solar-focused investment manager. We've got 15 years worth of experience in managing volatility in supply chains and in improving the transparency of them as well. So it's really starting to bear fruit, and I think it's another reason to like in investment trusts.
Excellent. Obviously, we last time touched on discounts in sort of some detail. And obviously, we're talking about renewables as being potentially particularly attractive. But obviously, in this environment, it's not impossible to raise sort of fresh capital. How are you adapting your sort of strategies to deal with this?
Yeah, maybe I'll kick off from our side. Certainly within GSEO, which is the listed trust we manage, we still have some dry powder left that we're in the process of deploying. So I think in terms of all the investment programs that we have globally at the moment, we are able to see those through, with the funds that we have fundamentally. I think also, at the moment, about 56%, I think, of the overall portfolio is generating because we are a transition strategy, so we have to invest in construction of assets. Otherwise, if we just buy operating assets, there's no transition happening. So 56%, that is supporting a 1.3 times dividend cover. So as that grows and we complete the build outs of those programs, we're going to have a much higher dividend coverage ratio, as it were, moving forward. So I think leverage is also something that we may consider moving forward as well. We're not a keen user of leverage in our investments. We'd rather deploy equity into these projects, de-risk them ourselves, and then look for capital optimization through the use of leverage, as these projects come on stream. So that could also release further capital as well. So the combination of cash flows coming out from assets going into operations and potential use of further leverage also will help us build out further.
I was dying to chime into this discussion earlier, and I thought it was an excellent point that our colleague up here made about the fundamentals of what's going on. This may be specific to our fund. We're a bit of a private equity fund that does renewables, and we just put hydrogen to one side what we're doing. So the investment thesis is that we invest £1 for something and we sell it for £5 in a few years' time. And it equally applies to the property discussion as well. I think if you had a portfolio of property at the moment, this is the worst time to say you wouldn't want to exit at the moment. So people know that we're all sitting on assets that we don't want to sell, and then so will become attractive when we start saying, well, we've just sold something for twice what we paid for it.
Yeah.
But we can't do that at the moment. In our case, it's because we've only just finished investing, and we've got to wait for these companies to mature before we get out. So there's a bit of a double whammy of the whole sector being negative. But I think in the private equity case, it's just because people have got assets they don't want to sell, and everybody knows that because they're managing them on behalf of their investors to make good money out of getting out of them. So whilst the market knows that, it's just going to the discount is magnified. I think it's multiplied. But so how can we fix it? Well, it wouldn't do us much good to start, and we don't actually have the cash to give back to investors at the moment. But what will change things for us is when we say, right, we've sold one of these portfolio companies we bought a few years ago for this kind of a multiple. And when people project that onto the rest of the fund, they'll say, well, I can actually make a lot of money out of this. And for us, that we're just getting into that window now where, globally, big industrial players have got 10-year investment horizons, and they figured out they are well behind on investing into hydrogen. And so they will start buying up electrolyzer producers, fuel cell makers from any moment now. So our fund is not about a gentle improvement in revenues from the companies. It's like a snap, somebody's bought one of the companies. I think that applies to the entire sort of private equity investment class. Yeah. So that's where, and to the question about, have you got enough cash to run? Yeah, well, we've got an excellent board. They grill us regularly to make sure that we can pass the going concern in 2 years' time. Yeah. But it's a tough place to be.
If I can add what we're doing. So the fundamentals of our listed vehicle are really strong, right? We've got a big portfolio of 100 operating assets. They continue to do what we want them to do. They've got long-term dated cash flows. There's nothing wrong with the underlying portfolio of assets. We are very comfortable with the way in which we drive things like the calculation of our net asset value. So we're very thoughtful around capital allocation and discipline around the way in which we use any available proceeds that we have and how we use them in the future. We're in the process of running a phased capital recycling program, partially to demonstrate NAV, partially also to release some capital to repay revolving credit facility. We have a really well-structured balance sheet, so we only have a small proportion of our debt that is not hedged and is subject to higher interest rates. So, it's about creating that or maintaining that discipline through the current operating environment and being prepared for when markets move in the right direction for us to continue that interesting growth journey that we have as a platform.
Richard, you were sort of talking about your dividend cover briefly there. So I'm going to pick up again. How sustainable is your dividend?
Yeah, clearly, I feel it is sustainable. I think there's a growth component to it that we're all very much aware of, and what we offer investors fundamentally is that pop, as it were. As our projects come on stream and start generating cash. So we're very comfortable in terms of that dividend coverage. We tell investors that we have a target growth target actually of 10% unlevered, and we're very comfortable of being able to achieve that. There's some really exciting projects that are due to come on stream within the next 12 months that we've worked very hard to ensure we're able to access differentiated yields on our projects. So yeah, very very confident about its sustainability.
Same really. So we are obviously looking again at the nature of the cash flows and the way in which we think about cash flows for the types of assets that we've got. Everything is super predictable. It's well understood. We're a professional in running the assets, so we can see what is coming down the road in terms of dividend cover. We're comfortable with where we are in terms of being able to maintain that. We have a progressive dividend policy. We've increased that in line with or greater than RPI for the last decade. So that shows how strong those fundamental assets are and the cash flows that they're kicking off.
Richard, if you were able to sell an asset, as you described, would you look to reinvest all of that, or would you consider sort of returning some of that to shareholders?
Depends what the time and the place, but let's assume this is going to happen within the next couple of years. If investors wanted some of that cash back, yes, we would consider doing that. We wouldn't say it all has to go back into reinvesting into the hydrogen sector, but by the time this starts to take place, which could be over the next 6 months to a year, I think people will start to see that they actually want that capital to be invested back into the hydrogen sector. What you'll see happening over the next few months is some very, very big global names coming into the hydrogen sector, some into the companies we've already invested into, and that will be exciting, and people will want us to be part of that. But if we'll take a bet, we'll talk to our investors, and if they want some of that back, we'll certainly do that.
So the next question really talks about the sort of intermittency of renewables, and obviously storage is going to be an increasingly important component of that. I mean, what is the future for storage? And perhaps for sort of Richard, is hydrogen going to be a significant part of that?
Yes. Let me start by the projects we've got that we're building in Germany. The first of which will take FID towards the end of this year. It's a 100 megawatt project. It's got battery storage with it because the entrepreneurs that set the business up, they made a lot of money in Germany doing the same thing. So they know what they're doing. And the reason for that is to get around the intermittency. Worst case, you might say solar would be a third to half of the day, giving you those sorts of load factors, which means you can only make hydro for that part of the day. So why not put battery storage in place, buy the green electricity when it's almost being given away, and then use that to get your load factors up. So basically, you can make hydrogen for 24 hours a day. It pushes the capex up, probably doubles the capex actually, but it's a relatively small part of the impact on value of a hydrogen product, as I was saying before. So yes, it's a very important part. The other way around it is to think about the source of electricity coming from hydroelectric, where you've got 100% load factor. You've got electricity 24 hours a day. So this goes back to the land grab of access to grid connection and access to the best and cheapest source of electricity. But yes, definitely a big part of it.
Yeah, look, I mean, the idea of facilitating, or intervening to ensure there is regular production of electricity in times when renewables don't produce. That's the core issue of our times. If we can help solve for that ability to store energy for a longer period of time, that storage and recycling of the green electrons will help very much in creating a stable energy system. And we've taken that thesis across all the different markets that we address, within the context of Australia, for example. Clearly, you would think there's a lot of solar resource during the day. In fact, there's so much solar resource the grid operator has to cut off production. They have to curtail production because the grid can't take it. But however, in the mornings and the evenings, they still have to call on coal-fired power plants and gas-fired power plants to be able to provide supply at inflated rates. So really, what we're seeing there is what we consider as a volatile and disorderly transition to net zero. So the opportunity set there, of course, is to add battery storage. And what we've done within the context of Australia is to what we call hybridize these solar sites, put on battery storage behind the meter with them in order to time shift the generation of clean renewables into the grid when it's needed most, and actually where you can get a better margin for it as well. And that's the opportunity set and the impact that we make for investors there. Within the context of the UK, we're doing a similar thing in what we call flexibility. We're actually using a highly efficient gas-fired power plant within the context of the UK, so not renewable technology at all. But what we're doing here, gas is very dependable in terms of dispatching it at short interventions, etc., or running it all the time on base load. We have a carbon capture unit on the site as well, so it captures the CO2 that gets produced. We scrub the CO2 into what we call food grade CO2, and we sell it into the food and beverage industry, where there is a chronic shortage of this product. In fact, a lot of the CO2 that goes to the food and beverage industry gets manufactured as a co-product of ammonia, which is a highly polluted way of producing purified CO2. It's also very costly. So we want to displace that as well. Within the context of Brazil, we actually acquired a hydropower facility last year because we realized within the context of Brazil, there is a significant amount of hydro resource that also enables the transition, because you can attract greater renewables into the market if you have a baseload capacity like hydro that supports it. And that's why we found it an interesting investment.
See, I think that's an excellent example of what you get with the renewable investment trust. That's a level of practical innovation that you wouldn't get with a utility, with the sort of conservatism that you get. And that's going to play into why this renewable trust sector will recover so quickly as well, because of the first mover advantage that we've got into all these things.
Do you have anything to add, Ross?
Not a huge amount. I think storage covers a lot of ground, and what's nice about particularly the UK market is it's leading the world in how it's integrating storage within its future energy scenario. So National Grid, for example, understands storage, how it wants to utilize storage alongside that distributed generation to, in a short duration term, balance the grid, take the burden off the volatile nature of the grid. And from a medium and long-term perspective, moving towards solving arbitrage on an intraday and even a seasonal basis. So there is a huge amount of opportunity. What is clear is flexibility and storage are a fundamental part of how we get to a sustainable future. So we have integrated storage on alongside our assets, and also on a standalone basis within our listed vehicle and in our development pipeline as well, because we do believe that it's a core part of how we will achieve net zero.
Excellent. Okay, very conscious that we're sort of running out of time here. So, conscious, obviously, the sector is very much trading at a discount. Just in saying, why should we be taking a serious look at your funds now? Ross?
Wants to start me? Great. So a lot of the headlines that I've already said. So, the fundamentals of our platform are 99 operational solar farm assets, plus some storage, plus some assets that are outside of the UK. Those assets are well managed by the leading solar professional in the space. We understand how we are delivering reliable, sustainable cash flows and yields from those today and out into the future. There is nothing wrong with any of the fundamentals. So today is a very interesting time to think about looking at this platform, given the discount in which it's operating.
Richard?
If we were all sitting in France or Germany today, we wouldn't have to explain to you why hydrogen is taking off, because you would see it, but you're not seeing it in the UK. But that doesn't mean to say it isn't happening globally, and there's evidence of that in our fund. Why now is the important point, because people might say, yeah, but I'm not sure about hydrogen. When's it actually going to start taking place? Why now? Because we're entering into the window where you're going to start to see exits from the fund, and that was the whole point of this fund, to put in £1 and take out £5, and we're going into that space now. Evidence for that is that there are companies inside the fund that have already appointed investment bank advisors to, and I can't obviously say which ones, to receive potential bids, and it's not really IPOs, it's trade sales that are going to light up the hydrogen sector. So we're going into that space now, and that's why you should be looking at hydrogen.
And finally, Richard.
Yeah, look, top line, 5% progressive dividend, 10% net IRR. We are growth orientated, currently 56% of the portfolio producing, covering 1.3 times dividend. That's set to grow over the next 6 to 12 months. I think the opportunity set, however, that we're facing off to is vast. It is absolutely vast. And I think if you were to restrict yourself to a single geography or a single technology, you would only get a smaller share of that. I think the fact that we are geographically focused we're globally focused, should I say, and technology agnostic within the energy transition allows us to access a much greater volume of high quality private markets energy transactions. And I think that's what investors should look forward to. We gave you a little peek there earlier on in terms of some of the ways we approach investments, and they're all pretty much differentiated.
Excellent. Well, thank you, gentlemen.